Welcome to Nasdaq Trade Talks. I'm your host, Jill Mlaandrino, global markets reporter at Nasdaq. Joining us at the market site in Times Square, we have Jay Gragnani. He's the head of research and client engagement over at Nasdaq Dorsey Wright with the Dorsey Wright monthly update. And last time we spoke in October, Jay, there was a situation with the yields, but they're kind of back to normal now. We'll get into that just shortly, but let's take a picture of the overall market with our first chart of the day with the S&P 500.
Yeah, and last time we were back here in October talking about how the market volatility had picked up really since the end of April. And we just now completed the sixth move of 5% or more in just as many months. And that is what a lot of investors have been feeling. Now, 3 of those were to the upside, 3 of those were to the downside. But just recently, in the month of October, the market, the S&P 500 specifically, but all of the major large cap indexes, the Nasdaq 100, the Dow Jones Industrial Average, all moving to new highs. And as we can see here on the chart of the S&P 500, that 3,020 level acted as a line of notable resistance for the S&P 500 for the past few months. It got there in July, at least initially, and then twice more during the month of September. None of those times were ever able to break through, but in the month of October, we were able to see the S&P break through that 30-20, get to 30-30, and it's been moving higher ever since then. And so when we're looking at that chart now, what we look at that 30-20 area was a form of resistance on the chart, will now form as a form of support coming back on the downside for the S&P 500. So that 30-20 is going to be our next area of support on the downside.
All right, let's take a look at the yield curve next. China, yes, making headlines, what's happening with trade deals, Brexit and so forth, but the fact that it's in a more normal state, that's a lot for markets.
That is, and that's something that we haven't heard a whole lot about. It's been all about, as you mentioned, China. It's been new highs in the S&P 500. There's a lot of news made about yield curves when they inverted back earlier in the year, but what we saw during the month of October is the yields, and that being the gray line there, is the recent as of the end of October, the purple line there being the beginning of October. Yields have normalized a bit in the sense that they are no longer inverted. The 3-month and the 10-year are no longer inverted. So yields have just gotten back to a more normal condition. And so we'll see certainly something to monitor from there, but I think something that is really in terms of noteworthy events, things that have flown under the radar a bit so far this month.
All right, let's talk about seasonality in November and December. Santa Claus rallies, we get the strong push into holiday 2019. Do you think we might get that seasonal push into the end of the year?
You know, it's always a fun time of year. You think about November 1st hits, and that starts and kicks off the seasonally strong period in the market. And it's one of those things that we've talked about for years, investors have talked about for years, but it's one of those things that has an extremely strong bias over time. And you look back over the years, and we were really first looked at this through the Stock Traders Almanac, as they did a lot of good research on here. But it's interesting when you look at this chart here, basically what you're looking at is a growth of the Dow Jones Industrial Average going all the way back to 1950. Had you just invested during the seasonally strong period, that period from November through the end of April, versus if you were investing through the weak period. And basically what we found is that that weak period, that seasonally weak 6 months between May and October, has basically been flat since 1950. Had you just invested in the seasonally strong period, that's where all of the gains in the market have come from. And so, we'll see how this year plays out. Obviously, the recency bias of last year, you remember the volatility that we got last quarter, although it was a strong period when you looked at the whole 6-month period because we got that rally at the beginning of the year. But another interesting point, out of the past 20 years, only 3 times has the S&P 500 or the Dow Jones Industrial Average been down during the seasonally strong 6-month period. 2000, 2007, 2008. So there certainly is a pretty strong bias towards that.
All right, let's wrap up with our last chart here. This is DALI. This is where you look for strength across the markets. So this is dynamic asset level investing that you focus on at Dorsey Wright.
That's right. This is one of our guiding lights when we think about building, constructing portfolios and providing research. It's always nice and fun to talk about a seasonal bias in the market. But when it really comes down to it, where we want to focus our investments is we look at what the market is telling us, what the market is doing. And right now, when we look at the markets, all of the asset classes through a relative strength lens, what we see is that U.S. equities continues to be the #1 ranked asset class over here to the far left-hand side. International is #2 and has been improving a little bit here. And then you get into fixed income and commodities coming down there. So if we're thinking about markets today, if we're thinking about where we want to place our assets and our overall asset allocation, we're looking at overweighting U.S. equities today.
That's been basically for all of 2019 for the most part.
For the entire of 2019, as a matter of fact, every day since August of 2016, it's been that way, where U.S. equities have been the dominant place.
Well, it certainly reflects in stock market performance for sure. Thank you so much, Jay, as always, for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Mlaandrino, Global Markets Reporter at NASDAQ.